A fool and his money are soon parted. If you've lost a lot of money from online trading advisories or from your own poor investing decisions, please pay close attention to this video. I want to invite you to test drive Portfolio Builder's weekly income platform free for 30 days. It's designed specifically for 50-plus-year-old investors that are going into retirement or have already retired and are in search of a safe and consistent income-generating strategy. Here's what you'll get during your 30-day test drive. Benefit number 1, a weekly trade alert to generate income no matter what the market does. This strategy consistently generates between $500 and $1,000 every single week per $100,000 worth of the underlying asset you own. No more and no less. If you've been touted better returns than this, it's because you're being sold an extremely risky strategy that's absolutely not suitable for retirement. Benefit number 2, this strategy does not risk losing your underlying asset. This builds a diversified portfolio of the top corporations around the world, then simply sells covered calls against the positions every Monday morning for weekly income. Benefit number 3, this decreases your portfolio concentration away from the United States. America is creating too much debt. For the past century, the United States was the biggest growth story, but now it's on the brink of civil war and piling on $1 trillion of debt per year while it goes down the gutter. You need global diversification through country index ETFs if you want long-term success and very little work on your end to generate income. Here's the global ETF outlook. Country ETFs tracking the most profitable companies in each region are popping up and making it extremely easy to build a diversified portfolio of the world's richest companies. Currently, there are 7 such superpower countries that are designed to create monthly or weekly income. And if you're still in overcrowded trades like Facebook, Amazon, Google, and Netflix, be warned. It won't be long until everyone panic sells all at once and those stocks crash by 50% or more. This strategy takes each country's yearly GDP and uses that to determine which percentage of your portfolio should invest into each country's index. And while the United States still has the greatest GDP, countries such as China, Japan, and Germany, also the UK, India, and Brazil, have been exponentially growing their GDP at a much faster rate than the United States in the past 3 decades. This will help reduce your political and business risks and positions your portfolio to capture maximum global growth over the next decade and beyond. Best of all, it's done with 7 extremely popular and highly liquid country ETF indexes. Combined, your underlying assets are diversified into hundreds of companies globally. As certain companies grow faster or slower in each country, your ETF funds will automatically adjust its holdings to track the most profitable companies. This puts technology and next to free management costs on your side so you can safely sell call options weekly for income and not worry about your underlying asset. In 2019, this plays out with a 27% portfolio position in America, a 16% position in China, a 7% position in Japan, a 6% position in Germany, a 5% position in the UK, a 5% position in Brazil, and a 4% position in India, and leaves 30% split between cash, gold, or digital money. By following the global GDP over the past 3 decades, you would have been alerted to invest in companies such as Microsoft, Amazon, Apple, Berkshire Hathaway, Johnson & Johnson, JP Morgan, Facebook, ExxonMobil, and Google. In China, you would have been in early on Tencent, Alibaba, Baidu, and many more extremely large corporations that are growing exponentially. In Japan, your top holdings are in Toyota, SoftBank, Sony, Mitsubishi. In Germany, you would have been accumulating shares of SAP, Allianz, Siemens, Bayer, even Adidas. In the United Kingdom, HSBC Bank, Royal Dutch Shell, and Unilever are popular brand names that almost everyone knows of here in the States. In Brazil, Unibanco, Petrobras, and the Banco de Brazil. And in India, the largest companies are Reliance, Housing Development Finance Corp, Infosystem, and Axis Bank. This strategy essentially owns a small piece of every corporation around the world that makes the most money in its region and automatically adjusts holdings via next to free ETF funds as companies gain or lose market share, leaving you with less than 1 hour of work to do per week to safely generate income for the rest of your life. Benefit number 4. This strategy also invests in 2-year leap put options that can return 10,000% or more in the next financial crisis. We all know what will eventually happen to the S&P 500. It's going to be a sight to see when this comes tumbling down, and quite likely leading up to its crash, other country indexes will tumble in front of, behind, and alongside it. By using a portion of our weekly income, this strategy can easily afford to purchase long-term crash insurance against each underlying asset it holds. Our goal will be to have at least 1% of our portfolio value invested into long-term, out-of-the-money put options during the next crash, which would effectively double the value of our entire portfolio if stocks crash by 50% or more. This gives us constant protection against another violent and systematic financial crisis like we saw most recently in 2008 and 2000. Benefit number 5. Even if stocks don't crash anytime soon, inflation is likely on its way due to trillions of dollars being printed by central banks all around the world. Through a gold and digital money hedge, we can protect our portfolio against this pile of debt. The USA with $21.8 trillion, China with $2.4 trillion, Japan $12.7 trillion, Germany $2.2 trillion, the UK $2.4 trillion, France $2.5 trillion, and India $1.2 trillion of debt. So what's the downside to all of this? Risk number 1. It limits equity appreciation while you generate weekly income. In other words, while you use your shares in these global corporations to generate consistent weekly income for retirement, you might miss out on some of the upside potential you could have captured by simply owning the stocks. Risk number 2. If the underlying asset went up in value too quickly, you could even lose the amount of shares you owned in each asset slowly over time. In a bull market, outright owning these equities or any specific index might outperform this strategy's return. But in a flat, choppy, or bear market, this strategy can greatly outperform offensively positioned strategies. Risk number 3, if you don't reinvest your weekly income, and if the underlying stock index were also to fall in value, this could significantly decrease the amount of weekly income your portfolio could generate. Risk number 4, week-to-week volatility dramatically increases and decreases the amount of potential income you can earn from selling covered calls against your ETF positions. This makes your weekly income slightly unpredictable. Although, as of creating this video, the potential to generate between $500 and $1,000 per week per $100,000 holding the underlying assets has been frequently possible. Risk number 5, the inflation hedge may not play out and lose money. Gold and digital money offers a good protective measure against inflation, but to date, inflation has remained elusive over the past decade, despite massive global money printing. Without inflation fears, gold and digital money positions may lose significant value. Risk number 6, protecting your stock positions from systematic panic crashes with put options is harder than it sounds. If you buy a put option, you usually have 3 things going against you. Every day that passes, the value of your option decreases in value, and towards its expiration, it exponentially decreases in value. This makes timing difficult. If the underlying goes higher from where you purchased the option, it can almost immediately lose 50% or more of its value just in a matter of days. And finally, you also have to accurately predict how far and fast an asset will crash in order to truly receive value from buying put options. To avoid this risk, we take a portion of our weekly income and reinvest it into 2-year out-of-the-money put options against each underlying asset. But this only gives us protection against violent market crashes and not slower recessions. The good news, if the market goes flat, choppy, or slightly down, our strategy generates consistent returns week after week, regardless of market direction. So let's sum up what you should expect if you decide to give Portfolio Builder's weekly income trader platform a test drive. Number 1, this strategy invests into a globally diversified index of 7 superpower country ETF index funds. Number 2, your position size per ETF is based on that country's GDP or wealth or ability to create money from the sale of products over the past year relative to other countries' GDP over the same period. Number 3, every Monday, the amount of shares held per ETF is rebalanced, and typically a near-the-money covered call is written against the shares to generate income. Number 4, a portion of the weekly premium collected can be used to purchase leap put options against market crashes for each underlying ETF we're holding. Number 5, a portion of the portfolio is also available to hedge against inflation risk with gold and digital money, which is designed to protect against huge amounts of world debt potentially causing rapid inflation. It's simple, it's sound, it's safe, and it's designed for generating defensive returns in retirement through global diversification and weekly option premium. So if you like the sound of Portfolio Builder's weekly income platform, now is the time for you to take action. Subscribe to this channel for a free daily video covering the profits, the losses, and every trade placed in our model follow-along portfolio. Make sure to click the bell button to automatically be notified when our new video comes out every Monday through Friday. Next, click on the link in the left-hand corner to sign up for a free 30-day trial to Portfolio Builder. A spreadsheet to manage your trades will be instantly delivered to your email address. The end. Or is it? Click here now to start your free trial.